Good afternoon to you all. Welcome to Future Online Academy. In today's class, we are going to take a look at Zimbabwe Advanced Level Paper 3, question number 1, November 2025. We are required to know the preparation of journal entries. As you all know, Future Online Academy is a home of exam coaching and also question and answer academy. I'm not going to take much of your time. Let's dive into the question. State any 3 characteristics of revenue reserves. The characteristics of revenue reserves, you need to be aware of what are reserves and also the types of reserves and the characteristics of each reserves and also the types within revenue reserves and capital reserves. That will be your homework actually. Do it on your spare time. But I highly encourage you to enter the examination knowing what are revenue reserves, what are capital reserves, especially in paper 1 multiple choice, Zimsec also. Then what are revenue reserves? These are reserves. Let me highlight here. What are revenue reserves? These are revenue reserves. These are profits. For example, the keyword you need to know is these are profits which are earned by a company, for example Econet or Delta or Net1, through its core business activities, which are the trading profits, and that have been intentionally held back rather than being paid out to shareholders as dividends. You need to know that these revenue reserves, they are held. For example, probably they are held intentionally and they are not being paid out to shareholders as dividends. When you are answering this type of question, if you are asked what are revenue reserves or distinguish between capital reserves and revenue reserves, please first provide us with a definition. But in this case, I gave you the definition for you to know what are revenue reserves. But I am now looking at the characteristics. Characteristic number 1 is the source of funds. You need to know the source of funds. That's the first characteristic. They are strictly created as distributable profits, whereby they are earned from the normal course of the business. Or, for example, it says these are the profits earned by a company. And the dividend availability is another characteristic, whereby saying this is whereby they can be used to pay dividends to shareholders, while its capital reserves usually cannot be used to pay dividends to shareholders. Then, without wasting much of your time, let's look at Rex Limited provided the following balances at 31 December 2021. 160,000 here represents the number. It represents the number of shares, the ordinary shares of dollar. Each dollar is the par value. The total will be 160 times dollar. You get $160,000. 60,000, 8% redeemable preference shares of dollar each. I am going to give you a task in this class. I want you to go and research on non-redeemable and redeemable preference shares, cumulative and non-cumulative preference shares, what are preference shares, and also go and research on those items. Then you need to know the 60,000 is the number of preference shares, 8% it is the dividend, like the percentage of the dividends. Then the dollar is the par value. We have capital redemption reserve, share premium, general reserve. You all need to know what is share premium, a capital reserve or a revenue reserve. Is income statement a capital reserve or a revenue reserve? You need to all know about that. Not wasting much of your time, let's look at January 1. Land was revalued to 52,000. 3 motor vehicles costing $4,000 were purchased on credit from CM Motors. Then a rights issue of 1 ordinary share for every 4 held was made $20 per share. 15 a bonus issue of 1 ordinary share for every 5 held was made by utilizing the capital redemption reserve. Then on the 24th, 16,000 8% redeemable preference shares were redeemed at a premium of 5 cents per share by utilizing funds from rights issue. The shares were originally issued at a premium of 10 cents per share. You need to be aware of that. Then on the 28th, inventory costing 10,000 was damaged. It can be sold for 9,000 after incurring repairing costs of 2,000. You are required to prepare the journal entries of these transactions, and in part 2 of this video we are going to take a look at how, after preparing the journal entries, how are you going to prepare the updated statement financial position. Stay tuned. Without wasting much of your time, according to the first one, land was revalued to 52,000. You need to know something. Land here, we are given that the land was 40,000, but we are being told that the land was revalued to 52,000. What does this mean? It means that the land actually increased the value by $12,000. Say 52,000 minus 40,000, you get $12,000. After getting $12,000, how do you prepare a journal entry of a revaluation? Henceforth, it will be non-current asset. You prepare non-current asset, then you debit the non-current asset, the increase, then you credit the revaluation reserve with the increase also. Then it will be, you write your date. Don't forget to write date, guys. January 1, land 52,000 minus 40,000. Also show the examiner the operation. Where are you getting the 12,000? Then revaluation reserve 12,000. I hope it will be done. If we write in this way, we'll actually obtain 4 marks. Then we are being told on this chapter, let's go back to our question. We are being told motor vehicles costing 4,000 were purchased on credit from CM Motors. Very unfortunate that I forgot to show you how you write this type of journal entry. But motor vehicles, they were purchased on credit. Henceforth, it means that you are going to debit, there is an increase in motor vehicles, you are going to debit motor vehicles with $4,000, and you are going to credit trade payables. Because credit, it shows that we bought it on credit. We are going to involve the trade payables account, and it will be credit trade payables of how much? Of $4,000. Then item 5, a rights issue of 1 ordinary share for every 4 held was made. A rights issue of 1 share for every 1 ordinary share for every 4 held. For every 4 held was made $1.20 per share. I want to give you an advice. When you're in an examination, you are reading your question, kindly, you will be with your pencil, kindly underline the keywords. For example, a rights issue is the keyword, 1 ordinary share for every 4 held is another keyword, was made $1.20 per share. First thing, you need to know what is a rights issue. A rights issue, it is whereby the company, for example, Econet or Delta, the company issues shares to existing, don't forget the word existing shareholders, the shareholders of the existing ones, they issue shares to existing shareholders at a price which is above the par value but below the market price. Don't forget to write those keywords. The keywords you need to know here is above the par value, below the market price. For example, we are going to say the market value. For example, Delta shares, they are trading, for example, currently, let's just say, I can't see the example, but let's just say currently Econet and Fraco shares, they are trading at, lastly when I checked, it was, let's just say 30 cents, because they are devaluating 30 cents. Henceforth, the existing shareholders, they will be given these Econet and Fraco shares of 30 cents at probably, for example, the par value of these Econet and Fraco shares might be, let's assume that it was 20 cents. It means that the par value is 20 cents. The existing shareholders will get these shares probably at 25 cents or between that range, but not precisely 30 cents, but below the market price. I hope we are clear on that one. Go and do a further research on that concept. Then a rights issue, what am I going to do? Don't worry, don't stress, guys. I'm going to assist you. In terms of a rights issue, let's go on rights issue. We need to know that there is the bank. We need to know this formula. The bank, why are we debiting the bank? Because the bank is going to increase a value. Why? We are receiving cash, we are receiving money upon this transaction. There is cash movement. Don't forget that in terms of rights issue. That's the first characteristic you need to know, that rights issue involve a cash movement. Then the share premium is also to increase, because the shareholder is receiving some shares, and the ordinary share, the shareholder is receiving some shares. Henceforth, his or her share capital is going to increase also. Henceforth, according to our transaction, let's go back to our question. According to our question, we are given that a rights issue of ordinary share was held. Before you go any further, go back to here. It's 160,000 ordinary shares of dollar each, which is $160,000. It's $160,000. Henceforth, it will be bank. Before we go any further, you need to write ordinary rights shares it will be existing shares are 160,000. You say 160,000 over 4, you get 160,000 over 4. What we did here, you get the 40,000 here. Then you multiply the par value, which will be 40,000. There are 40,000 shares, but you are not yet done, guys. You need to come and say the bank, which is 40,000 times the price which they were sold at, to be $20 and to be 48,000. Then ordinary shares, yes, 40,000 times dollar, which is the par value. Then share premium, you say the $20 minus dollar, 40,000 times 20 cents, you get 80,000, henceforth, leading us to the completion of the rights issue. I highly encourage you to go and read on rights issue. If these bonus issues and rights issues are new to you, kindly go and research on these concepts, because they will actually make you fail in an examination. I don't want you to fail, guys. I just want you to understand accounting, that you, when you are writing examinations or when you are writing your exercise at school, it will be actually easy. A bonus issue of 1 ordinary share for every 5 held was made by utilizing the capital redemption reserve. In this case, you need to know something. Here asked to, they've been utilizing the capital redemption reserve. But before we go by utilizing the capital redemption reserve, you need to know that in terms of bonus issues, we actually debit the revenue reserves. In most cases, they are the ones which can be used to finance a revenue reserve, to finance a bonus issue. Then you credit the ordinary shares. Why credit the ordinary shares? I'm not explaining. What are bonus issues? Bonus issues, these are shares which are given to existing shareholders at a free charge or at no cost. They are not even paying any figure, any amount. They're just being given these shares at free cost. Henceforth, the shareholder will actually have an increase on his ordinary share or the share on his share capital. That's why we are going to credit. While it's either going to use the revenue reserve to finance. But in this case, why did we debit the capital redemption reserve? We debited the capital redemption reserve because, as you can see, we debited the capital redemption reserve because we have been told to utilize the capital redemption reserve. We are going to debit the capital redemption reserve. Now we are moving on to item 24. On the January 24th, we'll be looking at the redemption. 16,000 8% preference shares were redeemed, bought back at a premium of 5 cents. They are given a premium of 5 cents per share by utilizing funds from rights issue. The shares were originally issued at a premium of 10 cents per share. Before I go to this transaction, I'm actually realizing that I forgot to tell you something. I forgot to tell you, in terms of calculating bonus issue, let's come back here. The ordinary shares in the question, remove this dollar, sorry. The ordinary shares were 160,000 actually. They were 160,000 in terms of bonus. They were 160,000 according to the question which was given. Then the rights issue were 160,000 times 1 over 4, because we've been told that 1 for every 4 held. So it will be 40,000. Then bonus issue, 200,000. Why 200,000? It's no longer 160,000 because we have 160,000 and the 40,000 of the rights issue you add, then you get 200,000. For example, in terms of the bonus issue, I've been told that it is 1 for every 5 held. Since it is 1 for every 5 held, it means that we are going to multiply by 1 over 5 and you get 40,000. That's where the 40,000 is coming from in terms of the bonus issue transaction. Then you multiply with the par value and you get $40,000. Let's go back to the bonus issue. I want to make sure that you understand. That's where we are getting the 40,000. You multiplied with the 40,000 shares times the par value of 40. Make sure you actually recall what I've said when you are answering your examination questions. And I hope we are now going on to redemption of shares. So in terms of redemption of shares, you need to know that, for example, our nominal value was 16,000. Let me go back to the question before I go any further. Our nominal value is 16,000, and our nominal value being 16,000. In terms of preparation of the journal entry, you debit the redeemable preference shares with 16,000. Then you come premium on redemption. The premium on redemption will be 16,000, the nominal value times the premium. Where am I getting the premium, the 5 cents? It is given on the question. It is the premium of 5 cents per share. then I debit that premium on 5 cents, debit the premium on 5 cents per share here, but we paid cash. So we are going to remember, according to redemption of shares, we are saying we are actually buying back the shares. Henceforth, we are giving a cash outflow. Money is going outside of the business, hence we are paying some cash. Since we are paying some cash, it is going to reduce the bank. That's why we credited bank. So crediting bank to be $16,800. We am getting a say 16,000 times 1.05, you get $16,800. Then, without wasting much of your time, you are not yet done, guys. We need to look at another concept. You are told that the shares were originally issued at a premium of 10 cents per share. Being told that they were originally issued at 10 cents per share, what are you going to do in terms of this aspect? We are not going to take a look at that, but you are going to prepare this one. Why are we going to actually record this 800 to debit the premium? Remember, since a fresh issue was made in the nominal value, we made a fresh issue and it is covered by those proceeds from the rights issue, right? Yes, because we have been told that we are going to come back to the question. You are told that the premium per share by utilizing funds from rights issue. Henceforth, we are going to make a fresh issue, and also it is going to be covered by the funds from rights issue. Hence, the $800 which is charged from against the $800 premium, which is against the share premium. So since they were originally issued at a premium or retained earning, so the $800, where's the $800? Let me come here. The $800 a year, it is typically a premium and is charged against the share premium account. That's why we are going to debit the share premium, whereby you're going to reduce it and credit the premium on redemption. Then you'll be awarded with marks. Why are we doing this? Because they were originally issued at premium or retained earnings. I hope we are clear on that aspect. Then we now want to move on to item 28, inventory costing $10,000 was damaged. It can be sold for $9,000 after incurring repairing cost of $2,000. First thing, you need to know something. Go and read on International Accounting Standards and also International Financial Reporting Standards. International Accounting Standard 2 is the one which actually caters for inventory valuation, whereby we are saying inventory is valued at the law of cost and net realizable value. Henceforth, the cost is $10,000, with the cost of the inventory which was damaged is $10,000, and the net realizable value, we are going to get it after saying the expected selling price, which is $9,000, minus the incurring repairing cost of $2,000, you get $7,000. But you are not yet done. Remember, inventory is valued at the law of cost and net realizable value. You are going to debit the income statement figure with how much? $10,000, the cost minus the net realizable value of $7,000, you get $3,000. Then you credit the inventory with $3,000. I hope this lecture was fruitful to you. I wish you the best in your examination preparations, and also don't forget to go and read further on the aspects which I have instructed you to go and research on.